Chapter 1: Origins of Power, the Rise of Larry Fink and BlackRock. If you want to understand who truly shapes the world's financial future, you have to look past the dazzling lights of Silicon Valley and the oil-rich fields of the Middle East. The biggest players aren't always the ones you know by name. In fact, the most powerful man in the world of money is someone the average person has likely never heard of. Welcome to the story of Larry Fink, the architect behind BlackRock, the shadow giant of global finance. Larry Fink was born in the early 1950s in Los Angeles to a middle-class family. His father ran a shoe store. His mother taught English at a local school. Fink's upbringing was modest but nurturing. He entered the world of finance with a keen eye for numbers and an insatiable curiosity for how money moved, not just through banks, but through the very veins of the global economy. In the late 1970s, the American economic landscape was shifting. The age of traditional manufacturing was being replaced by new ideas: Reaganomics, deregulation, and the rise of Wall Street intellectuals. Larry was swept up by the wave of change. After earning his degree at UCLA, he dove headfirst into the financial world, starting his career at First Boston, a prestigious investment bank. It was here that Fink would begin to understand the immense power embedded within the mechanisms of risk and debt. Fink was fascinated by the potential of mortgage-backed securities, a novel, complicated financial product that very few understood. He was one of the first to grasp how these securities could be bundled, sold, and transformed into a profitable system, fueling dreams of home ownership and massive wealth creation. Riding this wave, Larry Fink quickly rose through the ranks, earning millions for his firm and carving out a name as a financial visionary. But with great ambition comes great risk. In 1986, a devastating error in Fink's calculations cost his firm over $100 million. In the cutthroat arena of Wall Street, a mistake of this magnitude was career-ending for most, but for Fink, it was a turning point. Instead of retreating, he became obsessed with understanding risk, how to control it, how to minimize it, how to predict it with mathematical precision. This obsession would become the foundation of BlackRock. In 1988, Fink and 7 partners broke away to found a new company. This firm would not just manage assets, it would revolutionize how risk was analyzed and measured. The name, BlackRock. To outsiders, it sounded mysterious, almost ominous. Inside, the company was built on software, data, and discipline. Early on, they created Aladdin, their proprietary risk management system. Aladdin wasn't just an algorithm. It was a fortress, a surveillance tool peering into every corner of their financial operations, constantly recalculating risk and making sure that mistakes like Fink's disastrous error at First Boston would never happen again. As the world rushed to embrace financial innovation, BlackRock grew quietly but relentlessly. The firm collected clients from every corner of the globe, pension funds, governments, corporations, promising not just returns, but safety. They became the silent stewards of trillions, their power growing far beyond what anyone could publicly see. By the early 2000s, BlackRock had already become a global titan, managing more money than most countries. They controlled portfolios that included blue-chip giants, Apple, Microsoft, ExxonMobil, straddling continents and industries. Politicians and CEOs alike began to seek Larry Fink's advice, understanding that the fate of their fortunes rested in the shadowy calculations spilling out of BlackRock's servers. Yet if you asked Larry Fink about power, he would likely brush it aside. For him, the focus always returned to risk, to predicting it, taming it, and shaping the world in its image. He didn't want to be a celebrity. He wanted to stand in the background, quietly influencing global events with the precision of a chess grandmaster. In 2025, BlackRock sits atop more than $12.5 trillion, a sum that is almost unfathomable. If you were to spend $3 million every single day, it would take you thousands of years to even begin to make a dent in the company's assets. Its reach extends into every major economy, every industry, and every government in the world. The rise of Larry Fink and BlackRock isn't just about money. It's the story of how a single man's obsession with risk and the systems he built transformed the very foundation of capitalism. As you listen to this chapter, remember, in the quiet corners of global finance, it's not always the loudest voice that matters, but the most disciplined mind, armed with data, software, and relentless drive, who truly shapes the world. This is the foundation of our story, the beginning of a silent revolution, born from error and driven by vision that would echo across decades and continents, guiding not only the fate of markets, but the future of entire nations. Chapter 2: Transformation of American Capitalism. From Reaganomics to financial engineering. As the 1980s unfolded, Americans faced a world where old certainties were vanishing. Endless assembly lines, the proud roar of machines, workers clocking in and out. These symbols of prosperity were slowly fading into the past. Across the country, entire industries went silent. Families who had built their lives in the industrial heartland watched factories close, their skills made obsolete by the relentless march of progress. But in the heart of New York, far from the smokestacks of the Rust Belt, a different revolution was brewing. A quiet, sophisticated revolution fueled by numbers, software, and the mysterious energy of global finance. This was the dawn of the Reagan era. Lower taxes, deregulation, a belief in free markets so intense it bordered on faith. Politicians promised that unleashing capital would lift America to new heights. The reality, as always, was more complicated. Within this swirling landscape, the streets of Wall Street pulsed with a new kind of ambition. Suits were sharper, the computers faster. An army of financial engineers emerged. Quantitative analysts, coders, and visionaries, armed not with hammers or drills, but with algorithms and market models. Investment banks raced to create the future. Mortgage-backed securities, derivatives, credit swaps, a bewildering maze of financial products so innovative, so complex that many insiders barely grasped how they worked. Risks multiplied in the shadows, camouflaged by the glittering promise of profit. Among these pioneers stood Larry Fink, steeled by the lessons of his own shocking miscalculation. His failures at First Boston had branded him with a lifelong obsession to understand, quantify, and ultimately master the art of risk itself. While the world's attention hovered over fortunes being made and lost with breathtaking speed, Fink's focus turned to the back-office systems, the invisible software quietly managing billions. He understood, long before the rest, that in this new era, information and the power to analyze risk would trump even the largest physical assets. The 1980s were the golden age of financial engineering. Firms like Salomon Brothers and Goldman Sachs became legends. Young traders built empires overnight. Fortunes were made with the flick of a computer key. The power of money was no longer in what you owned, but what you could borrow, leverage, or invent. As financial products spread, so did the dangers. One misjudgment, a single disrupted equation, could send shockwaves through the market. No one was immune. Larry Fink, haunted by the ghost of lost millions, was determined not to repeat his mistakes. It wasn't enough to hope for the best outcome or trust lost in the wisdom of markets. Fink wanted data, certainty, and algorithms that could predict the future as reliably as possible. When he launched BlackRock with his hand-picked partners in 1988, his vision was clear. This would not be another investment company prone to the whims of the market. BlackRock would fuse engineering, mathematics, and analytical rigor into the very heart of finance. At the core was Aladdin, a technological marvel, a digital vault, and a nerve center. Aladdin's purpose wasn't just to track investments, but to peer into the soul of risk itself. It processed unimaginable volumes of information in real time. Market prices, credit histories, global events, allowing BlackRock to see patterns before others even noticed a change. For their clients, governments, pension funds, and corporations, it became a seatbelt in a runaway car. Through the 1990s, as markets boomed, crashed, and boomed again, BlackRock honed its reputation as the silent guardian of wealth. The dot-com frenzy erupted, internet stocks soared, and then came the spectacular collapse. Companies like Pets.com flashed into oblivion, fortunes evaporated, and for many, it felt as though the new world had come unmoored from reality. But for BlackRock and its clients, the pain was lessened. Their discipline, forged in the fires of data, had paid off. By the new millennium, BlackRock had become a titan, advising central banks and managing assets greater than the GDP of most nations. The world's financial system was no longer managed by men shouting on trading room floors or by politicians with sweeping speeches. The new rulers were invisible, algorithms, risk models, those who understood not just how money moved, but how danger could be measured, contained, and sometimes survived. Yet underneath this newfound confidence, the seeds of crisis had already begun to grow. The very complexity that enabled innovation made the system fragile. The further we venture, the closer we come to collapse or rebirth. As Chapter 2 draws to a close, we stand at the threshold, at the edge of the next great reckoning. Wall Street has changed, BlackRock has risen, and the world itself is poised for another transformation. One Fink and his creation would soon find themselves responsible for navigating. The question remains, can even the most powerful calculations predict the future? Or is the next storm already brewing beneath the surface, waiting to test the limits of risk and reward once again? Chapter 3. The Birth of Risk Management, From Ruin to Reinvention. When we think of power in finance, we imagine soaring profits, billion-dollar deals, and the pulse of global markets. But true power is forged in the crucible of catastrophe. When the system collapses, only those who understand risk rise from the rubble. For Larry Fink, the journey from ruin to reinvention became the foundation of BlackRock's legacy and would change the very way modern capitalism faces uncertainty. It all began with a dramatic failure that would haunt Fink for years. In the mid-1980s at First Boston, one miscalculation in the volatile territory of mortgage-backed securities cost the firm over $100 million. In the hyper-competitive world of Wall Street, such losses could end careers and erase reputations. But for Fink, the disaster was less humiliation than revelation. He realized the underpinning truth of modern finance. Risk isn't a vague danger lurking at the edges. It's the heart of every transaction, every choice, every moment the market is alive. Leaving First Boston was not just a change of scenery, it was an escape and a mission. In 1988, Fink gathered a handful of trusted partners to launch a different kind of company. Where others chased returns, BlackRock would chase security, a fortress built not on hope, but on relentless measurement and analysis of risk. At the center of this new empire was Aladdin, a proprietary risk model whose name would become legendary. Far more than software, Aladdin became the nervous system of BlackRock, a digital oracle capable of ingesting endless torrents of global financial data, stress-testing billions in assets, and predicting cracks in the system before they could shatter portfolios. Aladdin's algorithms were constantly evolving, reflecting the market's infinite complexity. Currencies, stock indices, political tremors, weather disasters, anything that could disrupt the flow of money was on its radar. BlackRock's clients, pension funds, governments, insurance giants, felt the world growing riskier by the month. The old certainties were gone. The new world was chaotic, digital, and interconnected, where a single misstep on Wall Street could ripple through every household from Tokyo to Toronto. In this climate, BlackRock's promise was simple yet revolutionary: to see the storm before it hit, and to chart a safer course through uncertainty. But the decade was merciless, pockmarked by spectacular booms and brutal busts that tested every financial institution's resolve. The dot-com bubbles soared on dreams, but crashed in a cascade of failed startups and evaporated billions. Major companies, once household names, disappeared overnight as the unpredictable dance of risk became ever more perilous. Through it all, BlackRock remained nearly invisible, never the flashiest name, but the quiet expert called in when fortunes were on the line. Their edge wasn't magic, but discipline, updating their models with every lesson learned, every close call. Risk for BlackRock wasn't a static enemy, but a living puzzle that demanded constant reinvention. Then came the ultimate trial, the global financial crisis of 2008. As mortgages defaulted and credit markets froze, other giants crumbled, and panic tore through every layer of the financial ecosystem. In the center of the storm, governments and corporations turned to BlackRock. The U.S. Treasury and Federal Reserve enlisted Fink's firm, not only to manage toxic assets, but to help sift through the debris, reconstruct balance sheets, and restore confidence to markets teetering on the brink. What set BlackRock apart wasn't merely its size or reach. It was its ability to process complexity on a scale no one else could match. They didn't just ride out chaos. They helped decode it, offering solutions built from years of obsessive, data-driven vigilance. After the crisis, BlackRock emerged even stronger. They acquired rivals, expanded Aladdin's power, and became architects of regulation and stability. Policymakers sought their advice, competitors tried to emulate their models, but BlackRock had already woven risk management into its DNA, shaping a future where calculation and adaptation define survival. Today, BlackRock's approach is regarded not only as a standard in the industry, but a philosophy. Risk isn't just something to fear. It's the engine of progress and innovation, provided you have the tools and discipline to control it. From the ashes of catastrophe, the world's largest asset manager built a system that transforms danger into opportunity, ensuring that each crisis is a lesson, every collapse a blueprint for reinvention. As this chapter fades, we stand on the threshold of BlackRock's continued evolution, an empire forged in the storms of finance, where understanding risk means not just surviving, but prevailing in a world that will always be unpredictable. And at its center, the belief that knowledge, discipline, and constant reinvention are the most enduring forms of power in the modern age. Chapter 4: Crashes and Opportunity, BlackRock and the Global Financial Crisis. There are moments in history when events outpace all calculations, when even the most sophisticated risk models tremble in the face of reality. The early 2000s on Wall Street were marked by dizzying growth and unchecked optimism. Global markets soared. Credit was cheap, and mortgage-backed securities, once a marvel of financial engineering, became the lifeblood of the boom. It appeared, at least on the surface, that the world had found a formula for endless prosperity. But below the surface, fault lines were forming. The rise of complex financial products also meant the creation of risks no one could fully see or understand. The housing bubble inflated, unchecked lending multiplied, and millions of mortgages were sliced, bundled, and traded with almost religious faith in the mathematics that underpinned their value. It was within this feverish context that BlackRock's expertise in risk management became more valuable than ever. The company had spent years refining Aladdin, a digital oracle built to see through chaos, to spot trouble before it arrived. But not even BlackRock could stop the unraveling once it began. In 2007 and 2008, a cascade of defaults, margin calls, and fear swept through the global financial system. Banks collapsed. Trading floors became scenes of crisis. Uncertainty ricocheted from New York to Tokyo and everywhere in between. This was not just a crash, it was a reckoning. Governments and central banks scrambled for answers. Trust in commerce, money, and institutions teetered on the edge. In these dire circumstances, BlackRock wasn't simply another player. It was summoned as a kind of emergency technician, a crisis manager with tools and insight that few others possessed. The U.S. Treasury and Federal Reserve turned to BlackRock to help sort through the chaos. The company's task was nothing less than to analyze and help value the toxic assets that threatened to sink economies. Mortgages gone bad, securities without buyers, the remnants of once mighty portfolios. Aladdin was pushed to its limits, processing mountains of data, calculating losses, and charting solutions in real time. These weren't just numbers on a screen, they represented the fates of millions. Families losing homes, retirees losing pensions, companies teetering near collapse. BlackRock's role was unprecedented. Behind closed doors, its experts worked alongside government officials, not just to patch up the system, but to design ways forward. They pioneered new strategies for selling assets, restructuring debt, and restoring confidence in the credit markets. The world wasn't just watching the rescue. It was relying on BlackRock's technological discipline to find a path back to stability. From the ashes of disaster, BlackRock grew stronger. The crisis cemented its reputation as the go-to advisor in moments of danger. Banks, pension funds, and even foreign governments sought its help, not just for investment advice, but for systemic solutions. The company expanded, absorbing competitors and developing new products in the aftermath. BlackRock's rise was no longer just a story of financial insight, but of strategic intervention at the highest levels. As markets began their slow recovery, BlackRock led a transformation in how risk was understood and managed. The crisis had revealed the limits of unchecked innovation. It proved that models can fail, that hubris can blind, and that discipline is irreplaceable in complexity. Regulators adopted new rules, often drawing on BlackRock's experience and data. Firms that had ignored risk management now tried to replicate the company's analytical systems, hoping to withstand storms yet to come. But with influence came scrutiny. Critics asked how much power a private company should wield in moments of public disaster. Could a single firm's advice shape policy too deeply? Was BlackRock now part of a regulatory shadow government, blurring lines between market participant and policymaker? For Larry Fink, these questions were the price of trust, proof that BlackRock's discipline fostered not just wealth, but responsibility. The aftermath of the global financial crisis was not a coda, but a new beginning. BlackRock had navigated disaster not only with its technology, but with its philosophy. Recognize risk, understand it deeply, and never forget that even the most sophisticated system must be ready for the unimaginable. The story of this chapter is not just how a company weathered a storm, but how it helped rebuild the world's confidence, ushering finance into an age where vigilance would mean survival and opportunity. Now, as the dust settled and markets sought new paths, BlackRock stood at the crossroads of power and responsibility. Not only as an asset manager, but as a quiet architect shaping how the world would face the next crisis. Because in finance, as in history, every crash is a test, and every test is a chance to build something stronger. Chapter 5. The New Age of Investment. The Index Fund Revolution and Global Power. After BlackRock's transformation through crisis, the next wave in finance didn't come with explosions or headlines. It arrived quietly, as a new way of owning the future. The age of stock picking and wild speculative bets was slowly giving way to something systematic, almost serene, but no less world-changing. The revolution of index funds and passive investing. The logic of these instruments was deceptively simple. Instead of trying to outsmart the market, what if you simply own the market? If you could buy a piece of the major companies in the world, ride the waves of their rises and falls, and do it all with minimal fees, why risk gambling on a single stock? The concept dated back decades, but it was in the 2000s and 2010s when the ETF, a low-cost fund that tracked indexes like the S&P 500, came of age for the masses. BlackRock seized the moment with its iShares brand, propelling the company into a new stratosphere of influence. Everyday savers, governments, and billionaires alike poured money into funds built to mirror entire economies. By 2025, BlackRock had amassed stakes in nearly every major company you could name. Apple, Microsoft, Ford, General Electric, Coca-Cola, ExxonMobil, and many more. The world's wealth now flowed in silent torrents through these indices, directed by tools and systems working quietly behind the scenes. The effect was profound. Power became less a matter of boardroom intrigue and more a question of allocation. Where would BlackRock's trillions of dollars flow this quarter, this year, this decade? Major blue-chip corporations, once answerable to a handful of high-stakes investors, now had to consider the priorities of vast passive funds. Board elections, executive pay, and corporate strategy could hinge on how BlackRock and its peers decided to vote. This new responsibility, however, came with mounting scrutiny. Three titans, BlackRock, Vanguard, and State Street, by now controlled significant shares of most household name firms. Commentators warned the market could become less competitive, innovation could slow, and corporate priorities might drift from the public good. Was it healthy that decisions affecting millions hinged not on voting shareholders, but on algorithms optimizing for risk-adjusted returns? The debate grew, especially as BlackRock took stands on environmental, societal, and governance (ESG) issues. Larry Fink used the company's weight to champion causes beyond the bottom line. In his now famous annual letter, he signaled that future investments would increasingly flow toward companies that embrace transparency, sustainability, and social responsibility. Some called this an overdue ethical reckoning for capitalism. Others saw it as overreach, unelected executives nudging the world's values by controlling the pipelines of passive investment. Inside BlackRock itself, the challenges kept multiplying. With every step forward in innovation, new ETFs for every niche, smarter algorithms, more powerful data analysis, came increasing complexity. A single shift in allocation, by design or mistake, could briefly unsettle even the world's most liquid markets. To manage this, BlackRock's specialists made Aladdin ever more sophisticated, monitoring risks and opportunities with a digital eye that never blinked. Yet the promise of this era was undeniable. In countries from the United States to China and beyond, ordinary citizens gained access to investment possibilities once reserved for the wealthy elite. Savings grew, retirement plans flourished, market efficiency improved, at least on paper. Money moved faster than ever, often at the literal speed of light as colossal sums zipped across networks in a fraction of a second. But questions endured. How much power was too much, especially when it was wielded quietly, beyond the reach of democratic scrutiny? Could passive funds unintentionally create the very bubbles and crises they promised to avoid? And what would happen if the world's faith in owning the whole market was challenged by a true black swan event? Even now, as BlackRock's assets reach heights few could imagine, a staggering $12.5 trillion by mid-decade, the company's leadership tries to balance ambition and caution. It steers between political winds, regulatory pressure, and its own quest to define not just investment, but responsibility. As Chapter 5 draws to a close, one idea resounds above all. The future of investment is collective, networked, and powerful, built on the foundation that BlackRock laid with risk management, then expanded into every corner of global wealth with the index fund revolution. Whether this new era makes the system safer, fairer, or simply more complicated, one fact remains. BlackRock is not just participating, but setting the course, its choices rippling through families, companies, and countries every day. This is the new face of power, invisible, mathematical, and woven into the very circuits of the modern world. Chapter 6: Influence, Controversy, and the Future. BlackRock's reach in the modern world. To stand at the summit of modern finance is to walk a solitary path under an unblinking spotlight. BlackRock, once an upstart born of Wall Street's upheavals, is now both a guardian and an enigma, so powerful that even world leaders and central banks must keep one eye on its every move. This chapter explores a paradox: the ascent to global dominance and the growing shadows of scrutiny and debate trailing close behind. It is 2025. BlackRock's reach is unprecedented. $12.5 trillion in assets under management. Positions in Apple, Microsoft, General Electric, Ford, Coca-Cola, ExxonMobil, and countless other household names. The company doesn't just allocate money, it helps decide the trajectory of industries and, indirectly, even national economies. Its ETF empire, managed largely through the acclaimed iShares line, quietly knits global finance together. Voting stakes acquired through these funds grant the company a seat at the world's most important boardroom tables. Yet the same scale that brings respect also sparks concern. Too big to ignore, say some. Too big to control, say others. If size alone was unsettling, BlackRock's influence over policy and governance, especially through environmental, social, and governance, ESG advocacy, generates even more heated debate. Larry Fink's annual shareholder letters, once suitable for industry insiders, have become global events. In them, he calls for climate responsibility, equity, and long-term societal thinking. In response, some governments and CEOs see partnership and urgency. Others suspect overreach and an unelected agenda. Financial journalists and policymakers argue, should a private American firm, albeit the largest of its kind, possess the clout to nudge whole sectors toward or away from fossil fuels, to shape transparency in labor, to lobby for new corporate law through market pressure. In some circles, BlackRock's market votes on climate or labor have the heft of policymaking itself, and its embrace of ESG has shifted capital on a planetary scale. Resistance, too, is mounting. Some U.S. states and international critics push back, worried about undue influence, values clashing with local politics, or the risks of groupthink embedded in index fund management. Others argue that BlackRock and its peers, by owning large shares of nearly every major listed company, could inadvertently create shadow monopolies or dull competitive innovation. If a crisis were ever to ripple through passive funds, who could predict what dominoes would fall? Meanwhile, the line between public and private responsibility blurs ever further. BlackRock's role as an advisor to U.S. Treasury, the Federal Reserve, even the European Central Bank, intensifies these questions. When global crises hit, regulators do not just consult with BlackRock. They partner, sometimes even rely, on the company's models and data. After all, BlackRock saw from the inside how fragile the system could become. Their digital nerve center, Aladdin, monitors trillions in real time for shocks and stresses. It's a power matched by few, envied by many, and understood by almost no one outside the firm's glass towers. Inside those towers, the pressure is relentless. BlackRock's teams refine algorithms, parse market sentiment, and brace for black swan disruptions that never seem far away, from pandemics to wars to technological upheaval. They absorb criticism, navigate regulatory gauntlets, and debate whether to act as guides, followers, or referees in the next era of capitalism. The company's own leaders know, with immense capital comes a duty not just to clients, but to the very system that enables their existence. For all the controversy, BlackRock presses on. It invests in new technologies, expands in emerging markets, pushes forward on digitization. The world, watching closely, wonders whether the company's centrality is a stabilizing force or a single point of failure on a scale never before seen. Is BlackRock the insurance of last resort, or the invisible hand steering the ship ever more subtly? The final conundrum is this: what future do we want for global finance? Do we trust private actors like BlackRock, shielded by market discipline, but unanchored by direct democracy, to continue guiding giants and nations? Or is it time for new checks, balances, and even philosophies of stewardship? As competitors rise, as regulation tightens, and as public expectations evolve, BlackRock stands at a crossroads, poised to write not just the next chapter of its own story, but of the financial world's as well. When the dust settles, two truths endure. Power, in the digital age, is quieter but farther reaching than ever before. And the debates around BlackRock's influence, its benefits, its dangers, its legacy, are likely only beginning. The watchers are being watched, and the balance of our intertwined destinies remains, for now, in very few hands. This is not a conclusion. It's an invitation to question, to probe, and to imagine the new forms of oversight and trust that a world of trillion-dollar actors demands. BlackRock writes the future with every investment, every algorithm, and every silent vote cast as trillions move, unseen, reshaping the world. The story is not finished. It is only pausing, waiting for the next turn in the cycle of power, risk, and possibility. Conclusion: BlackRock's era and the echoes of financial power. As our journey through BlackRock's story comes to an end, the scale and subtlety of its influence stand undeniably clear. What began with one man's obsession to outsmart risk has become a narrative about the very architecture of power in our global economy. Each chapter, from the birth of risk management to the triumph of passive investing, from handling financial crises to shaping policy and corporate governance, reveals how BlackRock's reach now stretches across continents, industries, and the destinies of millions. Today, BlackRock is not just the world's largest asset manager. It is a system within the system, part emergency technician, part architect, and part referee for capitalism. Its algorithms aren't just calculating market swings, they are quietly guiding the flows of trillions, determining which industries flourish and which ones adapt, holding the economic fate of both nations and ordinary people close to its digital core. But with profound concentration of power comes profound questions and challenges. Is it healthy for so much influence to reside with a handful of global financial institutions? Can passive money truly be passive when voting stakes dictate boardroom decisions? When does advocacy become overreach, and where is the line between responsible stewardship and undemocratic dominance? Governments and regulators worldwide remain vigilant. Rival voices, whether political, corporate, or from civil society, call for checks, accountability, and new definitions of transparency. BlackRock faces these dilemmas with the same discipline it applied to its first risk models: studying, adjusting, evolving. The company knows that tomorrow's storms may not resemble yesterday's, and so it keeps innovating, investing in AI, digitization, and emerging markets. Society's expectations grow alongside its assets. Larry Fink and his team walk the balance beam between ambition and caution, knowing that every move resonates beyond quarterly profits, into the realms of climate, labor, governance, and macroeconomic destiny. As you reflect on BlackRock's story, consider this. Financial power, once loud and visible in trading pits and company boardrooms, now works quietly in algorithms, networks, and policy corridors. The outcomes may be shared, but the decisions are not always public. The age of invisible empires is here, and the lesson from BlackRock is one for all of us. Every system built on risk must ultimately answer to the trust and scrutiny of those whose lives it shapes. In this era of silent influence, the next chapter is unwritten. It belongs to the new generation of thinkers, leaders, and citizens deciding who will watch the watchers, set new boundaries, and steer the course through uncharted waters. BlackRock's saga ends for now, leaving echoes that remind us, in a world woven together by finance, every risk, every choice, and every act of responsibility matters. The future of power will not look like the past. And the question remains, what kind of world will we build with the tools, the trust, and the vigilance we've inherited? Whatever the answer, the story of BlackRock has shown us that the stakes are higher than ever, and the possibilities as vast as the very markets it helped create.